Wayne. Welcome to Rebank.
Thank you for having me, Aman.
It is so fitting to be here today. We're at Launchpad Studios talking about entertainment finance in the middle of an airfield. So this is something new and fitting that we've
What a first for both of us.
Exactly.
My first podcast.
Exactly.
And your first video podcast.
Exactly. So we're going to talk about something very interesting and not a lot of people have thought about before, but the world of entertainment generally doesn't associate itself with finance. And I think people forget how important finance is in terms of getting content out there. And as people say, content is king. Netflix, Amazon, Hulu, all these big tech giants spending billions and billions of dollars on content. It's very interesting to see how that money flows through that value chain and what innovation we can see in this space. So I'm looking forward to talking about how Purely is attacking this market. And so maybe for context, Wayne, it would be helpful to give people a little bit of a background about what Purely is and what you do.
Okay, great. Well, firstly, thank you for having me and inviting us on the show. Purely Capital is a entertainment receivables financier. We launched about a year ago, and our objective is to help cash flow long-dated contracted revenues that come from licenses of entertainment content. And I'm sure we can talk a bit more about the value chain as you talked about, but typically speaking, when Netflix, Amazon, Disney, Viacom, and the big streamers and broadcasters license content from third-party distributors and rights owners, they acquire or license those rights for a term in their territory or territories, which could be the world in a Netflix scenario, or Amazon or Disney or Apple, or could be localized to a territory, a country. And typically they will agree a term and a territory and then a license period. And that will then have contracted payment dates throughout the license contract. And they can span up to 5 years. So for a rights owner, producer or distributor, you can seal a fantastic deal with a big streamer like Netflix or Disney or Amazon, who will license your show for maybe multiple millions of dollars, but then pay you over 36 months or longer. And where Purely comes in is we will crystallize and accelerate that receivable on day one, on signature of contract, or shortly after, and accelerate that value of that receivable in a matter of days, and then we'll wait the 36 months to 60 months for the contracted revenues to flow through.
Fascinating. So you're basically enabling content creators to get paid quicker so that they can pay their actors and so on when they need to, and not have to wait for Netflix's, Amazon's money to come in.
Yeah, I think that's one way of looking at it. Yeah. I think, well, we have three kind of customers. We have distributors, rights owners, and producers. Normally, at the point in time when we're getting involved, the actors and the productions have actually been made. So all the associated production costs have already been incurred. We're not really engaging in the development and production of content, which is a whole nother landscape of financing. And you talk about associating financing with entertainment. I mean, money is so critical. Finance is so critical to the development, production, distribution, and then monetization of an asset throughout the whole chain, from idea to marketing an asset that's finished to an audience. And there are a variety of different models and risk profiles around at what stage you get involved in a particular investment opportunity around an entertainment asset. But focusing on more completed product, so films, TV shows that have already been made, they've already been produced, so there has been an entity or entities, whether they be banks, lenders, institutional or private high net worths, who have financed a production, maybe with pre-selling distribution rights to distributors prior, so broadcast streamers getting involved at an idea stage, But when purely kind of step in is when the asset has been finalized, it's been delivered, and we're now looking at the next 2, 3, 4, 5 years of revenue streams. And if they are contracted, if they are reliable, so it's not based on box office or performance or clicks or views, but if it is a known quantity contracted revenue that just pays over time, we can factor that today and accelerate that to the rights owner, distributor or producer who may want to refinance their existing finance, pay back their investors, or just recycle the money into new assets to grow their library and continue the journey all over again.
Fascinating. I've never thought about the world of entertainment from that lens. Why is it now the right time? I mean, we've seen the online platforms really get into this game. Did this exist, I don't know, 20 years back when these online platforms weren't there, or are we really now seeing this element of
it's a great question. So we're in this kind of interesting shift in the way we consume content. There's always been, in the last 10, 20 years, there's always been different ways to watch films and TV shows. Typically, to watch a movie, you'd go to the cinema. And then for many years, there would be the buying of DVDs or renting of DVDs or video cassettes before DVDs. So for many years, your core revenue streams of a movie asset would come from theatrical and then video, the home video, revenue streams. And broadcasting would be your third kind of monetization route. Licensing to the BBC or, ITV or, HBO or Lifetime, whoever, which would always come after any kind of push in terms of trying to get you to watch the film in the cinema, buy the DVD when it became available, rent it at Blockbusters, buy the box set with the repackaging and behind the scenes, and then eventually a year and a half after that kind of windowing, it'd be on TV. Sure. What happened with the kind of development of obviously faster internet and broadband and the iTunes and Amazon with their transactional video on demand businesses was it allowed video rental not being on a cassette anymore, but actually just downloading it. And the rental and purchasing of content didn't change. It just you just did it through a digital mechanism instead of a physical mechanism. And then Netflix changed the game. They went from a postal video on demand service to a streaming all-you-can-eat on demand film service with a monthly subscription fee. And that has certainly, over the last few years, changed the attitudes of how the biggest distributors and rights owners of content in the world, the big 5, 6 entertainment companies, are having to look at how they talk to their customer. And instead of looking at all these different windows to monetize an asset, which ultimately is going through multiple retailers. Sure. They are building these direct-to-consumer offerings to compete with the fast-growing Netflix. So in the old days, I say the old days, we're not looking that old, but in the last 5, 10 years ago, a distributor or rights owner would be monetizing through theatrical and home video, and the revenue streams were quite quick. You could generate receipts 30, 60, 90 days from an asset being released. You got reporting from Tesco's or Walmart every 30, 60, 90 days with money flowing. So your lag time of income as a distributor was not that long. And the majority of your revenues were coming from theatrical and home video. But as the tide has shifted and the consumption patterns have shifted, and I would argue that the majority of consumers are not buying DVDs or renting DVDs, but they're subscribing to a streamer, the revenue streams for an asset have moved to become more valuable from the streaming and broadcasting windows.
So you're saying all the revenue you generate generally in today's world doesn't happen on the first day or the first week, but over the life because of this content library. And as a result,
I would even go further and say you could license all of your rights to a Netflix or Amazon, and that is your only revenue stream. there is no theatrical. There are no DVDs. There are no other way to watch the movie other than that streaming platform in that territory or territories.
Yeah.
If they buy all rights, which they do, and in one or multiple territories, that is the only revenue stream. So now instead of having maybe, 5, 6, 7 different revenue streams over the course of a life of an asset, you now have one.
Yeah.
And that one pays you over 36 to 60 months. So fundamentally, there is a shift in consumption, but there's also been a bigger push where the majority of revenues are coming from a fewer pool of long-dated contracted revenues. And that has put a strain on the distributors and rights owners in turning that money quicker.
Very interesting.
And cash flow. And that's where Purely tried to step in. So, my background is I used to finance and produce independent feature films. And typically we would go to the market, you'd pre-sell the movies at Cannes or Toronto or, Sundance, and you'd get 1 to 15 different distributors pre-buying your movie before you've made it based on the script, the cast, the director, the budget, just the concept. We had great success making movies this way. And then you'd go to a lender, either someone like myself, or you'd go to a bank and you say, look, I've got 15 contracts from these really good distributors all over the world. I've got a tax credit for shooting in the UK, and you get $9 million to make a $9 million movie. You make the film, and then those distributors pay you. Everything's really good.
Got it.
Now, you go to the market, you make your film, and you sell it to Netflix, let's say, or Amazon, or Disney, or HBO Max. And they say, great, we love it. We're going to give you $11 million on your $9 million movie. Brilliant. But we're going to pay you over 3 years. Not so brilliant.
Fair.
So this is where Purely was derived, because I was finding that an increasing number of producers and rights owners were having great success in licensing their content to the newer platforms, but finding that the payment terms really killed their revenue and their margin because the cost of interest on their existing production loans was not able to offset the upside in selling. So that's where the penny dropped, if you like. It's like, this is the growth. This is the future. It's not like suddenly there's going to be a resurgence of DVDs. Sure. So my view was, okay, where's the growth? 120 billion in content spend in 2019 from the big companies, all pushing for content that primarily is going to be direct-to-consumer driven. A lot of this content is going to pay for over multiple payments over years. I'm going to focus on trying to accelerate that for my customers.
So I guess the big question is, there are banks that have done this traditionally, right?
Of course.
Whether this is in LA, and I think if you make an analogy to maybe what's happening in the retail space, so everybody talks about challenger banks, the Monzos, the N26s, the Revoluts of the world. It's fascinating that entertainment is now kind of carving a niche out for itself, because these banks, the Macquaries, the JP Morgans of the world, have built big balance sheets of I'm not sure exactly how much they lent, but
big entertainment
billions.
assets.
Exactly.
Absolutely.
Exactly. How do you see this evolving, particularly for them, right? How do they think about this space today, with regards to Netflix and some of the online distribution platforms? Are they ready for this, or is there a niche to be carved out here? We were talking a little bit before about the sports entertainment bank, 23 Cap, that is focused on financing player transfers.
Yep.
I mean, that's fascinating. This there are niches now to be carved out in the banking space that is not only focused on retail and neobanking.
Yeah, and I think in the same way as other industries have got frustrated with traditional banks' approach to lending, both in terms of approach, speed, inefficiency, and just the whole kind of process, challengers, whether it be someone like Purely in entertainment receivables or 22 Capital with sport financing, take a different approach. And I think that's where it's exciting. From a cost perspective, the banks are always going to be, the most competitive pricing on the market.
What is pricing like typically?
I mean, for, credit rated, blue chip media and tech companies like the Amazons, Apples, Googles, AT&Ts, Comcasts, which is kind of the world I play in, It's very, very narrow. We're looking in a range of LIBOR plus 2 to 4 a year on reducing balance.
Wow, that's very competitive.
Very competitive. So to be able to actually be competitive in that space, and firstly, you've got to find a cost of capital that can allow you to play in that pocket, which is limited to a certain extent. Separately, though, where can you differentiate? Where's my competitive advantage? Well, my view was looking at the workflow. I'm going to focus on one thing. I'm not going to try and be all things to all people. It's very easy to get sucked into entertainment financing because every producer and distributor has another financing need. I've got another film I'm developing. Do you want to do a gap loan? I've got this tax credit I need financing. So you can easily end up doing a very wide portfolio, which is maybe a really attractive opportunity for some lenders. But as a receivables financer, I took the view of purely, we're going to do one thing. We'll do one thing and one thing only. We're not going to get involved with any other entertainment financing, certainly for now. Mm-hmm. That allows us to be very focused. And then I looked at technology. How can technology assist my journey for my customer, accelerate the process of buying a long-dated contracted receivable from a blue-chip counterparty, standardize it, and then do it in rapid speed? Now, speed is important to people, and if you're always going to be looking for a race to the bottom of the cheapest price, and you're happy to wait 4 months for a deal, then fine. But a lot of my customers, and I would argue a lot of the industry, would rather a deal done in a few days and a couple of weeks or less. And certainly, once you've done the first one, to know that every deal that follows is going to be incredibly simple, rather than going through hoops and. I mean, I've been there. I've done it. I've done it with lenders. I've been lucky enough to have been part of, $300 million of fundraising and investing in over 125 movies. So I've dealt with nearly all the big lenders in the space who, in the main, are all brilliant and they all do a great job, but a lot of them are inefficient. And I think our strength is being able to find a standardized and streamlined approach through technology to drive as much of the process, standardized contracts, standardized approach, and hopefully be able to deliver, much better results in terms of speed, competitive price for our clients.
Fascinating. So maybe a fundamental existential question. This might be a little bit controversial. How do you see the platforms that are spending all this money evolving from a financing standpoint? At some stage, Netflix is making, I think, 20 billion in revenue. They're spending 20 billion on content.
And then there's the on-balance sheet and off-balance sheet, concerns as well.
Is Netflix going to be around in I don't know, 10 years?
I mean, my humble personal opinion is I think so. I mean, I look at the landscape, and obviously, we look at this on a regular basis based on pricing, and how the market is viewing these big media and tech companies. It's a fascinating time. And when you look at some of these players, let's take Netflix aside for 1 second, but you look at the Amazons and the Apples of the world, the content side of their businesses is a fraction of their business. Amazon Prime, Amazon's a shopping platform that has added entertainment as a small piece of its pie, a significant piece for us as consumers, but really it's about getting you to pay $9.99 a month for free delivery. And Amazon content is kind of thrown in as part of that bundle. And for Apple, you buy a new iPhone and you get content. They're in the hardware business, and they're making brilliant gadgets for us all to consume. With Netflix,
I guess those two are a little bit different because they have a lot of cash.
But I'm looking at the landscape, and if you look at the Disney and AT&T and Comcast, you have obviously big businesses, big multinational businesses that focus on many different aspects, and entertainment is a core chunk. With Warner as part of AT&T and HBO, and Universal as part of Comcast, but it's not the only income stream and revenue stream. So they have a little bit more malleability, I think, in
Sure.
terms of sustainability. Plus the content libraries of these big studios. They have been in entertainment for many, many years. They have vast libraries. They have incredible content, global distribution deals. I think there's a lot to be said for these guys propping up and disappearing in 2 to 5 years. I don't believe it will happen. With Netflix, they are so far ahead, and they are forcing an industry to change the way that it monetizes its content. I mean, unreal, really, when you think about it. Breaking down windows, breaking down distribution, routes that have been set in stone for decades, and getting a company like Disney to suddenly make content that goes straight to the consumer that they would have normally published and put out on cinema and DVD and all the other avenues that they would have supported. So I think it's terrific what they're doing. I think they have a vast head start. And I personally think they have such an eclectic library that I think it's complementary to any of the other services that are being offered. There will always be a concern of churn, and sustainability. I think the biggest risk here is in the cord cutting for the traditional cable providers. It's the Sky televisions and your cable providers that are going to feel the pinch more than anyone. I mean, do you have Sky Television?
Yeah, I do.
So how much is your monthly Sky bill?
I think with broadband, 90 quid.
So you're in the 90 to 100 pound a month, and in America that would be cheap. I think most households with cable are paying in excess of $100 a month on cable.
Definitely.
You could have all 5 or 6 of the big streaming platforms and probably be in for less than $60 a month, with more content or just enough content. So yes, live is still an important part. News, weather, sport is still aspects that need to be figured out in the streaming world. Amazon are making a big push for sport, though, as you would have seen, and licensing certain sport rights with Premier League, tennis, etc. But I think the cable and satellite routes into your living room are more exposed than whether Netflix will survive alongside Disney, Apple, Amazon, and HBO in Peacock, in my opinion. Definitely. I think it's more likely that we will see a shift of you will have your core subscription channels with 2 or 3. If you have kids and you like franchise movies and your Marvel and your Star Wars, Disney will be in your armory.
Yeah. Going back, Wayne, to the financing side and the banks again. So we spoke a little bit about speed and why that is so crucial for a lot of these rights owners. Do you feel these banks, maybe who are the big banks that really do this? And do you feel they will need to change at some stage, or do they focus on one component of film financing, which is, I don't know, maybe pre-production, and that's what they want to go deeper into? Like, how do you see the financing landscape changing from a bank's perspective?
Okay, so, I mean, obviously the big banks have, I'm sure, positions in all the big studios and all the, the bigger companies, from your JP Morgans to, your Goldman Sachs. They all have some stake and some alignment to the new world of streaming and broadcasting. The Los Angeles-based entertainment lending banks focus more, I would say, on the single picture business. And when I say single picture business, I mean financing of one film at a time, as opposed to studio slates or businesses, that are churning over a lot more content. So Comerica, City National Bank, CIT Bank, Wells Fargo, East West Bank, that kind of Beverly Hills strip of entertainment lending banks that are competitively going after the top tier TV and film content, offering a traditional lending against pre-sold distribution contracts, tax credits, maybe gap against unsold. There's an argument and maybe a whole other conversation of how sustainable that market is given this new world, but it's a very competitive landscape. In the UK, we have Barclays, Coutts, Lumi were in it for a while, but they've kind of pulled back a bit, and there will be startups. And then there are the non-bank lenders and investors in film and television shows, of which there are maybe a dozen or so globally that are very competitive, and they're probably the next level up for independent film, TV and film productions, from your Ingeniouses to Headgear to, in the US you have 3 Point Capital and Bondit and these kind of concoction of non-bank lenders who will be a little bit more expensive, probably in that kind of high single-digit, low teen price range, but maybe take that little bit extra view on gap or tax credit and just stretch your budget a little bit further. I personally think the receivable business has less competition because the margins are so tight. This is a low margin, high volume business. You need a very specific and focused approach, and the ability to source a very cheap cost of capital to be competitive. If you came to me with a Netflix contract and I said to you it's 12% a year and it's a 3-year contract, you're going to laugh at me and say, no, thank you. I'd rather wait 4 months and talk to, one of the banks in Los Angeles. Albeit that if I'm in France or Germany or Scandinavia, maybe I don't have access to my Beverly Hills bank. And this is another thing. This is a global business. And I don't think it's very easy to forget that content is becoming more and more localized. And your Netflix and Disney and Amazon are launching in every territory in the world. And they are publishing and producing and buying localized content everywhere to increase the subscriber growth in every regional territory. So for us as an opportunity to focus on international customers, maybe those not in Beverly Hills and not able to knock on the door at Comerica or City National Bank, and have that relationship with their Beverly Hills bank manager, but instead be able to, talk to an Italian distributor who, has an Amazon contract that, is paying over 2 years and actually hasn't got a lender locally that understands it as an asset class to be able to give him money.
Very interesting. How do you feel technology changes this, right? So we spoke a little bit about how Purely is kind of standardizing a lot of the elements, particularly on the legal side where it's a lot of grunt work right now, right? All these contracts are maybe have their own nuances and you need to spend a lot of time and money. We spoke a little bit about Alibaba trying to tokenize
very exciting
a film. What do you see from a technology standpoint that is going to be supremely interesting in this entertainment finance space?
I mean, a lot is talk about blockchain and whether that can help play a role in both, adding transparency to payment flows, both to content owners, rights owners, and even the participants of an asset. I think we're a bit premature and a bit early for that to really be something that is mainstream. But I would hope in the years to come, it does, take over.
So you think the ability to use blockchain, again, maybe in 5-10 years from now, to be able to distribute to payments to right holders.
Exactly. So, when you think about content, we're very much focused on the monetization of a specific asset, but behind that asset, there are lots of stakeholders. And the moment the reporting and transparency around how an asset earns is very opaque. It takes a long time for information to flow back to a rights owner or stakeholder of an asset. And sometimes they don't get any kind of reporting. And it's so far after the event that it's almost a bit kind of irrelevant. And there's the notorious studio accounting that's always there's lots of stories about never really getting accurate accounting and having to do lots of audits. So blockchain can play a really good part in providing transparency around payments and income streams for any participant in an asset. I think that's exciting, but I think that's a long way to come. And I know there's a lot of ideas and startups looking at ways to try and look at that from a collections point of view. In terms of actual financing, using technology to assist customers to transact, to use digital signatures, to be able to use AI to look at contracts in rapid speed to check for inconsistencies or clauses that may be different, as opposed to having to have humans reviewing contracts and paying lots of money to do that over and over again. The legal costs around financial transactions are sometimes disproportionate to the deal. That's another big issue and another thing that Purely are trying to solve. If you look at a traditional financing, it's not unusual to have $50,000, $75,000, $100,000 in legal fees to do a simple receivable deal. Wow. And to us, that's kind of crazy. We're trying to, reduce that, dramatically down into the $5,000 to $10,000, $15,000 a deal instead of $50,000, $75,000, $100,000 a deal. There are legal witnesses. You do need lawyers. You need to register security. You need to do due diligence on the ownership of the asset and the chain of title. But there's lots of that you can automate, especially with standardized contracts. And license agreements don't tend to change that much. Yeah. If Netflix is licensing thousands of titles a year, they're not rewriting the agreement every single time. It's inefficient. So you've got consistency, you've got standardized versions, and then you can just look at the differences to make sure it is qualifiable. Yeah. So technology can really assist in those ways. I also think it assists brilliantly in monitoring and managing an asset throughout its life cycle. You're dealing with lots of revenue streams from lots of global customers, and technology really assists in being able to know where you stand at every point in every single deal, as well as communicating with your obligors that they owe you money and they're paying the right place. Yeah, yeah. So I think there's lots of ways it can help. The truth is,
we're still in early days.
We're very, very early days, and and everything that I'm trying to build with my tech team and my our CTO Dean has been designing this platform with me now for over a year. Everything we're trying to do is also very much baby steps. It's saying, look, this is how we do it, and we're not going to try and reinvent the whole wheel. We're going to try and improve it. We're going to use technology to improve it. And then slowly but surely, we're going to add and fine-tune and add other elements in to make us even more and more efficient. But the key is really getting money to customers quickly. And I think, to your point, how do banks look at this? To me, I think it's a fantastic opportunity. When you look at the opportunity to really align yourself with pretty highly rated media and tech companies compared to maybe less certain SMEs who are monetizing assets, it's a much better credit rating. Therefore, it's a more stable and consistent asset class to invest against.
Very interesting. Do you see yourself working with a bank in the future? I mean, I'm making an analogy right now to the mortgage space, for instance. Banks are notoriously known in this space to take a lot of time to process your mortgage, which doesn't make sense for the consumer at all. In fact, from a bank's perspective, it's just costly, right? They have to have a branch, they have to have a person talking on the phone to you, checking all your documents. Yep. They almost would rather say, hey, we're sitting on this pot of capital that is cheap and we want to be able to lend it for a mortgage. Let us find distribution partners, i.e. like purely in the mortgage space, to distribute this capital and let the partners do what they do better than us, service the customer. Do you see that happening?
100%. I think I'm already seeing it in the conversations I'm having about our facilities and growing our facilities into to meet our growth. We're talking to the big banks. I mean, ultimately, to set up a shop to try and do this and regionalize, and it's expensive and it's a very relationship business, the entertainment business. And if you've the infrastructure to set up and understand this kind of very specialist asset class, it's niche, it's specialist, but it's very large and scalable. You need the right kind of team behind it. So I definitely think this is a great opportunity for institutional lenders that may not have large exposures to these blue chip media and tech companies, but want to achieve an asset allocation towards that kind of income stream that is contracted, reliable, consistent, backed by maybe credit insurance or blue chip receivables. And using a proper operator who knows the industry, knows the people, knows his clients very well, and knows the asset class very well.
Fascinating. Finally, Wayne, circling back to Purely,
Yes.
where are you guys today? Maybe give the audience a sense of what you've done, what the future looks like.
Okay, great. So we're just in the process of closing a very significant facility, about $150 million, to carry us through, hopefully over the next 9 to 12 months. We've got pretty significant pipeline, probably as we are today in the $50-60 million of pipeline to close over the next 2-3 months as well. So we're in a very exciting position to pivot to our next phase. The platform is live, albeit in a kind of beta version, and our aim over the next 12 months is to onboard another 1 or 2 facilities, hopefully hit our first 100 million of financing out the door, and crack on and scale for the next few years ahead.
Fascinating. Good luck with that.
Thank you. Well, thank you for having me today.
Wayne, thanks a lot.
It's been great to chat.
Absolutely.
And big fan of Rebank. And thanks to LaunchPod for hosting this first video podcast.
Absolutely.
It's been great to chat about entertainment financing and purely.capital for any of your listeners who want to check us out or drop me an email.
Fantastic. Thanks, Wayne.
Thanks.